All right. Good afternoon, everyone. I'm Bernardo Kaiserman, Bradesco LATAM economist. Together with me, we have Sebastian Ronda, our LATAM economist too, in our team. We have the pleasure and the honor of having Claudio Soto today with us. A very timely call to discuss his views and present the recently published IPoM. So without further ado, Claudio will start with the presentation, and then we'll go to Q&A. If you want to ask a question, you can put them on the Q&A chat, and we will address them to Claudio. Claudio, thank you very much. The floor is yours.
Okay, thank you, Bernardo. Thank you, Bradesco, for the invitation for this talk. As you said, we just released the IPoM yesterday. It was presented in the Senate. So it's very timely, this seminar. And the information that we'll share with you is fresh. It's our fresh view for the macro in Chile. We just had our monetary policy meeting on Monday also. On Tuesday, sorry. So we have a just recent decision made and also the publication of the report. So let me just give you a brief outline of this report, then I will go in deep to some elements here. First of all, the main news in this report are related to the local scenario. We haven't changed much our external scenario view. There is still uncertainty in the global economy, but the news are coming this time around from the local scenarios. I will be more precise on that in a moment. Second, inflation has continued to decline as we anticipated in our previous report in June, but core inflation has exceeded our previous projection. This is one of the main elements I would say in this report. What explained this greater core inflation? Well, we link it to domestic spending that has surprised us on the upside, and also some cost push shocks that have affected mostly core inflation. Overall, we have changed our outlook for activity and demand for this year and next year. We have revised upward our forecast for domestic demand and also for activity for this year and next year. But then in 2027, the economy should go back to trend. We haven't changed our view regarding the trend growth. Therefore, already in a 2 years horizon, we see the economy coming back to trend. That's why we haven't changed our view for growth on that horizon. So let me go briefly on the external scenario. What is our view on the external scenario? Well, first of all, despite the fact that uncertainty has receded somehow, you can see it in several indicators there. There are still sources of uncertainty that are relevant. The trade conflict on the one hand, geopolitical tensions on the other hand. Also, we highlight in this report the fiscal situation in developed countries, the threat of higher expenditure, public expenditure has somehow materialized. This higher expenditure is linked to defense mostly. So it has consolidated this view that from now onwards we will have higher debts probably, and that could create some tensions or some risk on financial variables. Also, we highlight in the report as a new source of uncertainty the institutional situation in the US that will eventually condition the decision of the Fed or future action by the Fed. Now, in terms of the trade war itself, what is clear to us is that there was some anticipation by trade links. We saw a surge in imports at the beginning of this year, then a reduction in imports by the US. And when you look at the export of the Eurozone and China, There is a very clear pattern there. In the case of the Eurozone, there was also an anticipation with a surge in export at the beginning of the year, but then a cool down, a slowdown in export, mostly to the US. And in the case of China, there was no such anticipation according to the data, but there have been clearly a change in the pattern of trade, with less export to the US and, well, export to the rest of the world with a slightly pick up there, but clearly less export to the US. So there have been changes in the pattern of trade across the world, with a clear anticipation. So there were some inventories accumulation at the beginning of the year that help us to explain why up to now we haven't seen much impact neither on activity nor on inflation, although there are some signs in the case of inflation that goods more exposed to the tariff have been, their prices have been increasing more than other prices. Well, in this context, in general, financial conditions have tended to be more benign. We have seen a rebound in stock markets, currency appreciations all across the world, vis-a-vis the depreciation of the dollar, and falls in interest rates. On the one hand, up to now, less impact on activity, probably has reduced some risk premia. And then the expectation that the Fed will act more aggressively in terms of cutting rate already this year has also helped to improve financial condition across the board, in particular in Chile, where we have seen a very rapid increase in the stock market, and also falls in long-term interest rates. Now, in terms of the actions by the Fed, well, you know, the market now has been pricing in 2 or more cuts already this year, and then for next year, the curve has moved below to what the Fed itself pointed to with the dots here. So now the market is expecting a more aggressive action by the Fed. To one hand, that is related to certain views regarding the labor market with the revision of employment figures downward. But here we notice that there are risks, in particular regarding the fiscal position. You know, in the graph in the center, you see how the fiscal deficit is projected to be high for some years already. So there will be pressures on the fiscal side in terms of eventual inflationary pressures and rates. And the other thing that we highlight in our report is that part of the reduction in employment might be linked to supply side consideration. We did an exercise here trying to disentangle what explained the changes in the real wage in the US. And we see that the fall in immigration flows explain to some extent why we have seen a decrease in employment altogether with an increase in wages. So part of the weakness in the labor market is related to supply side consideration, lower participation of immigrants in the labor force that has pushed up wage cost. Having said that, that means that basically that there are some inflationary risk on top of what we can see from tariff, and also on top of what we can see coming from the public sector position in terms of fiscal debt. Now, in terms of activity, we have revised upward very slightly our forecast for this year and next year for our trade partners. In our previous IPoM, we were expecting a 2.6% growth on average between 2025 and 2027. And now we see 2.7% growth. The reasons are coming mainly from the Eurozone that has been more resilient in this part of the cycle, and also China that has surprised us on the upside in terms of activity. In terms of the term of trade for Chile, we haven't changed the view for copper. we still think that the copper price should be around 4.3% per pound. Currently, the price is slightly above that figure, but we have remained with that vision for several months already. Already in March, we were expecting a 4.3%, $4.3 per pound. And now we keep that view for this year and next year's. And now in terms of the oil price, well, at the beginning of the year, we had a forecast of dollar per barrel at around 69. Now we have it at 68, so very similar to what we had in March. In June, when we saw a rapid decrease in the price of oil, we revised it downward. Now we are revising it a bit upward. But overall, we haven't changed much our view in terms of commodity prices and therefore in terms of our term of trades. Now, going to the local economy now. One of the main elements of the report and one of the things that we highlight is that we have seen more dynamism in domestic demand, mostly linked to investment, but also in terms of private consumption. So let me begin by discussing investment. Here they are the numbers. On the left-hand side, you see gross fixed capital formation, the red line, and then we have the two main components, equipment, the blue line, and then construction, the green line. And in all series here, which are seasonally adjusted, we see a very fast increase in the second quarter of this year. When you look at more high-frequency data for equipment, mostly imports of capital goods, again, we see that at the margin, there is still very high dynamism of investment. Where does it come from? Well, to a large extent, it comes from the mining sector. We have seen since a while already a very important increase in mining investment, which has a lot of spillover to other sectors, but is the main driver for this cycle of investment. And also we have seen a rebound in energy, that is the green line on the right-hand side. Other sectors are more subdued. We haven't seen a very rapid increase in investment in those other sectors. Here we have some heterogeneity. For example, the building construction is still it's lagging behind quite substantially yet. In other sector, we see some signs of a recovery, but where clearly is a much stronger recovery is in energy and also clearly in the case of the mining activities, which are pushing up investment more generally speaking. The outlook for the future, based on the data that we have already up to the second quarter and part of the third quarter, plus the survey that is done by the Corporación de Bienes de Capital, the Capital Goods Corporation, which is a survey to large projects in Chile, shows that there are still revision on the upside in terms of the projects coming into the pipeline. That's why we have revised again the forecast for this year for investment from 3.7% in our previous report up to 5.5%, and also next year from 3.6% to 4.3%. Then in 2027, we see investment running more closely to trend at 3.1%. So these are good news in terms of activity and a very important revision for investment. I won't comment more in detail on some other fundamentals, but when you see, for example, the stock market, which usually is a leading indicator for investment, is very coherent what we see there to what we see with the data here, and also it is coherent to our changing view regarding inflation investment for the future. Now, in terms of consumption, we also have seen some more dynamism. We had a small surprise in the second quarter when we got the data for private consumption. In this case, we have also revised upward the forecast, but not to a large extent as in the case of investment. For example, for this year, we have moved up the forecast from 2.2% up to 2.7%, and next year from 2% to up to 2.3%. Then in 2027, consumption again should be running at 2%, around 2%, which is similar to trend GDP, trend output. What are the fundamentals here to explain some more dynamism in terms of consumption? When on the one hand, we see the wage bill growing, at the margin also we see a slight pickup here. Then the financial burden by household has decreased. This is a combination of lower debt and lower interest rates on consumption credits. And also consumption expectation have moved up. Here we have two indicators that are related to household expectation, and we see more optimism here, plus those other two factors that are part of the fundamentals that explain consumption. That's why we are revising upward our view for consumption. I will comment a bit on the labor market here, because the wage bill has been growing, but here there is a combination that is not so usual, which is high wages, which is the graph on the left-hand side, plus slow job creation. The unemployment rate, in fact, has been going up. You can see that in the middle. Job search time has gone up, so we see weaker job creation, more generally speaking, but wages have been going up. To some extent, that is related to some regulatory innovations in the country, increasing the minimum wage, for example, that has pushed up wages, but also we have this slowdown in employment and job creation. Altogether, that implies that in terms of the wage bill, which I showed you in the previous slide, we see some dynamism at the margin that sustain consumption and will sustain consumption into the future. Now, in terms of the current account, not many changes here. We see a current account deficit running at around 2% this year and next year. This is a combination of, the recovery in demand. That's why we have revised upward a bit the deficit, but not too much. The high copper price explain also that in terms of the value export, the situation is improving. But in terms of quantities, we see more demand for import goods, and that's why they tend to net out, and that's why we haven't changed much our view in terms of the current account. Finally, activity has been more or less aligned to what we were expecting. At the beginning of the year, we saw a more rapid growth, but we said at that moment in our inflation report in March, for example, that there were some temporary factors that were impacting on activity. With the data that we have now, we can confirm that those factors were in fact transitory factors, like what we see there on the red line on the right-hand side, the wholesale and retail sales. That was related to some extent to a wave of tourism that we had at the beginning of the year, and also a very rapid increase in export, which were linked to good crops and good fishing season that were reflected in the wholesale component of activity. But we knew that there were transitory factors and that they should fade away, and we are being confirming that. But all in all, since we have an increasing demand, domestic demand through consumption and investment, we expect that the following quarters activity should grow a little bit more than what we were expecting previously. That's why we have shortened the range for growth this year, cutting the lower part of the range, and we have moved up the range of growth for next year a quarter percentage point up. So a bit more growth this year already and next year. I will go in detail on this, but in terms of activity, the news are not so important as in the case of demand. Also, another important thing here is that in the case of mining activity, where we saw at the beginning of the year more dynamism, mining activity will be affected by an accident that we had in a very important a very important mine in the south of the country that would have macro impact, and that is also a factor in terms of activity forecast. So again, here there are the numbers. As I said, we cut the lower part of the range for growth this year. Our previous range was between 2 and 275. Now the range for growth is 225 to 275. So the median point or the average of the range is a bit higher. And also for next year, we have revised upward the full range, a quarter of percentage point up. And again, for 2027, we see the economy running at its trend. So we haven't changed our view regarding the trend. That's why we keep our forecast for growth in 2027. In terms of the output gap, the revised figure implies that the output gap was positive at the beginning of the year. We should see a moderation in the second quarter already. We saw a moderation, and also the third and the fourth quarter, we should see some moderation. Why we had this positive number for the output gap at the beginning of the year? Well, all those transitory factors that I mentioned before had an impact on the gap, but they are being fading away. That's why the output gap should be around zero already by the third quarter, and then slightly negative for some quarters, and then returning to zero basically in 2027. Well, in terms of inflation now, inflation has come down as we were expecting. The last figure known this week, 4%, was pretty much aligned to what we were expecting in our previous IPoM, so we haven't had any news there. But when you look at the components of inflation, we have some news here. Core components have been going up above to what we were expecting. Core inflation is running at 3.9%, whereas the volatile component has come down more rapidly than what we were expecting. So the news here is that core inflation has been going up above to what we were expecting. Inflation expectations are pretty well anchored. They are very stick at 3%. We had some spike in inflation expectation on a two years horizon. At the beginning of the year, we were very outspoken because of that in our inflation report in March, but then inflation expectation re-anchored to the 3%, and that's why we feel confident in terms of inflation expectation right now. And since inflation is running, overall inflation is running as expected, also we are relatively confident that inflation will keep on going down. In this report, we expect inflation to reach the target by the middle of next year, in the third quarter, to be more precisely. Inflation should be at around target, slightly later than what we were expecting in June, but there is no substantial change in the view for inflation. But there is a change in the component. We see core inflation to be more persistent, running above to what we were expecting previously. The volatile component running below. That's why overall inflation is pretty much similar. And here there is a risk. Being a volatile component, the source of the decline in inflation next year, since it is a volatile component, well, there are some risks there, and that's why we in our monetary policy, we highlighted the fact that we have to be cautious, because these core component tend to be more persistent. That could be a risk for inflation down the road. Well, finally, in terms of the monetary policy, we cut the interest rate in our policy report by the end of July. This time around, this week, we kept the rate at 4.75. That was pretty much aligned to what the market was expecting. Overall, the strategy is pretty coherent to what we have been signalizing already since March, in the sense that we should be moving towards a neutral range over time, as long as we are confident that inflation will be sitting at the target within our horizon, then we should be moving the policy rate to a value that is coherent to the neutral range. We haven't changed the neutral range between 3.5 and 4.5. The rate is slightly above that range. Therefore, there are some space to cut. But there is some uncertainty regarding the range. And probably since there is a change in view in terms of the balance between savings and investment, globally speaking, probably there is a view in general in the world that neutral rates have tended to move up. Eventually we will revise our estimation for the neutral rate. We didn't do it right now, but probably the neutral rate is in the upper part of that range. Therefore, the space for cutting rate to move it to the neutral level is not too much what we have left there to move. Okay. So that is the inflation report. Those are the highlights, and now I'm open for questions.
Thank you very much, Claudio. I'll start with a question precisely on how restrictive monetary policy is right now. Your point that you just ended. There's a few questions there already in the chat about that. So one goes, if we are approaching the neutral range, do you think it would be helpful to provide a clear signal about how much room there is still for continued cutting? And how much room we have to reach the center of the neutral range, 4%.
Well, we have some room, but not too much. Not too much in the sense that we are very close to the range. It is a range as of now. We don't have a precise point. We use a point estimate for our models and for our forecast. But in terms of a policy conduction, which has some more qualitative elements, we have a range of values. And therefore, we have less space now to move down the rate, because we're very close to the range of neutral levels. And we will have to evaluate with the coming data to see whether we have some more room that or less room that you can see from the data right now.
Two very quick follow-ups. One, on the potential revision to the neutral rate, are you also in favor of waiting for the new census to come up in January, perhaps potentially do one in March 2026? And the second is, if we look at the real ex-ante rate, we are already in restrictive stance. Is this also your assessment? Is your preferred, your favorite way of looking at that, or you would still consider the nominal? What is your assessment?
Well, two things here. Well, in terms of the moment to evaluate, we didn't do the evaluation for trend output, because the census data is important to reassess the dynamics in the labor market and productivity. The set of models that we have to calibrate the neutral interest rate, some of them are based on trend growth. So to be coherent to a revision of the neutral rate, probably would be better to have a reassessment of trend growth. But we are not precisely clear on the timing of the data coming from the census. Okay, so it's true that we will have some data coming in at the beginning of the year, but it's not clear whether we will have the whole data that we need to reassess productivity and labor. Therefore, we will have to evaluate at that moment whether we should keep on waiting or do whatever we can with the data that we have at that moment. Okay. But it would be ideal to have the whole data and do the assessment all together. But we will have to see. Okay. Now, in terms of the stance, the real rate, ex-ante real rate, is measured against inflation expectation on different horizons. So you have a varieties of view there. Real rates probably are lower now if you take short-term inflation expectation that have moved up in part due to supply shocks. And therefore, the real rates have moved a bit down. But if you take the nominal rate and you use our range for nominal interest rate in the long term, we still are on the contractionary side, but very mildly. We're speaking about very few basis points. So it's mildly or slightly contractionary, the monetary stance, if you do take the nominal. Okay.
Perfect. Thanks, Seba.
Can you explain us, Claudio, why was core inflation revised higher from this quarter until the third quarter of 2026, mainly due to services or another component? And if then you can explain why does it fall so quickly or sharply in the second half of 2026?
Okay. So core inflation, on the one hand, has surprised us on the upside. So there is the starting point for core inflation is higher, and that will have an impact on year-on-year readings for a few quarters. And also there are some fundamentals. We have more depreciated currency, nominal terms. And then we have the revision on domestic demand. So there are some demand factors also explaining somehow the dynamics of core inflation. Cost factors also help to explain what we have seen up to now. But I have to say that the last number that we saw for wages came down. So there is some persistency on the impact of cost factor on core inflation. The good thing is that at the margin we see the cost factor coming down, receding a bit, but there could have some impact down the road. So it's a combination of cost factor coming from labor cost and also the currency, and also some demand factors coming from the revision of consumption mainly. And why it comes down so sharply? Well, we had a very high surprise a couple of months ago, so there is a base effect there. We don't expect to. There was this Cyber Day in June in Chile that we have some noisy readings with the decrease and a jump up, and that's why we have this base effect that will have to reduce sharply inflation.
Perfect. And in the monetary policy statement and also in the IPoM, you mentioned that you will be evaluating the persistent and the trend of the core inflation. Can you tell us a little bit what metric models or variables do you use to evaluate this?
Well, we have a forecast for core inflation, and then we have to see on a monthly basis where the actual reading are coherent to that forecast. And then we have several models to try to explain what is going on with core inflation based on fundamentals, demand, cost factors. As I said, there are some more statistical models, there are some more structural models. So we have a bunch of analytical tools that help us to analyze what is going on. The important thing is that we have a baseline forecast for core inflation, and now we have to see where the data that is coming in is correct with that forecast or not.
Claudio, still on core inflation, but making a link with the corridor. I would argue that the path that the new IPoM brought for core inflation for the next few months is relatively high, or in other words, the bar is relatively low for the central bank to be surprised on the downside. lower inflation, core inflation. If that is the case, how open do you think you'll be, or to bringing forward again the cuts that were postponed?
So the thing is that we have had some noisy data also in terms of core inflation, because we had a couple of surprises on the downside at the beginning of the year. Then we had surprises on the upside. And the last reading, I would say that it was on the downside, at least to the market. So there are fundamentals that explain the persistency of core inflation. That's why we have changed our baseline scenario. But in terms of risk, there are elements on both sides, I would say. The currency has been appreciating in recent days. We see some receding in the labor cost. But then, of course, there is all the persistency that usually is related to core inflation. So the balance of risk is not too much tilted, but I have to say that, usually speaking, core inflation tends to be more persistent. That's why we highlighted that. Now, in terms of the conduction of monetary policy, we have to look through some shocks. If the sources of deviation of inflation, broadly speaking, and core inflation in particular, are linked to specific factors that we can identify, that are once and for all shocks that we can identify, well, that means that we can live through that and do not change much our policy stance. Now, if we see a combination of factors, more fundamental factors, that can create inflationary pressure or reduce inflationary pressures on a more persistent basis, then we will have to readjust our monetary policy strategy.
Okay, and one follow-up on the strategy. Can you elaborate on, so if we look at the corridor, there is one cut priced in for the end of the year, December, and then one cut in the second half of 26, and then just one, well, in our own calculation, one cut in early 2027, perhaps two in second half of 2026. So what is the strategy behind this very long pause and between these cutting now in December and then these two of the second and third cuts only in the second half of 2026 and perhaps even early 2027? Isn't it a little bit, yeah, well, elaborate, please.
Well, what is behind is basically the view for the evolution of inflation and its fundamentals. Particularly now we have been revising up demand. Demand implies that, at least coming from demand, there will be some more pressures on inflation. We have to counteract that with a less expansionary policy, let's say, or more contractive policy. Well, depends how you read it. But what we have for the policy rate is basically moving into the range of neutral values by the beginning of next year or at the end of this year. And that is coherent to go, adjusting slowly the impact on demand so that inflation converges. But once we are within the range, that is more fine-tuning, I would say, for monetary policy. So the precise timing of cuts will be much more related to what we see as the whole scenario. When you're far away from neutral levels and when you see that inflation is moving in a particular direction, it's much more clear the way of setting the strategy. Once we are more close to neutral values, either for inflation, we're closer to target, or for the monetary policy, when you're closer to the neutral range, it's a matter of more fine-tuning. It's not really a strategy so forward-looking.
Thank you. Seba?
I wanted to ask about the inflation expectations. So as you show in your presentation, the survey-based expectations are at 3%, but we have seen since the half of August that the swaps are above 3%. Some days they even have been at 3.5%. What is your reading about these recent dynamics in the one-year swaps?
Yeah, it has been more volatile. We also saw some reading below 3% couple of months, 1 month ago or a couple of weeks ago. Now it has moved up actually, but up to now we see it more as a noisy signal rather than as a clear signal that there are some concern regarding inflation. When we look at inflation expectation, we tend to have an holistic view in the sense that we take the swap rates, but also we take surveys, we take a bunch of measures to have a more comprehensive view. Swap rates, of course, are informative, but up to now, those movements are more noise, I would say, rather than signaling a really concern by markets that inflation will be going up.
On the Fed, Claudio. So, as you mentioned in your remarks, the market is now pricing in 3 cuts, or almost that for 2025 and 3 more 26. The central bank in the IPoM, you had 2 cuts in 25, 20, and 2 more in 26. If we really go into the scenario of the Fed cutting sequentially from starting September, how these extra cuts affect your scenario?
So we basically, in our baseline scenario, we have an appreciation of the currency, of our currency, the peso. We see it to be above values coherent to long-term equilibrium in terms of the real exchange rate. Therefore, we see the real exchange rate should be appreciating along the forecasting horizon. The timing of the appreciation in our models depend on the interest rate differentials. If the Fed were to cut more than what we have earlier or more aggressively, that could impact the interest rate differential, and that could have an impact on the currency. As long as it is a real surprise for the market, because already the market has pricing the cuts that we're talking about. Therefore, it's not clear how much it will have an impact on the currency itself. But if it were to have an impact, and if it were to appreciate more intensively the currency, that could have an impact on inflation. And if that impact is significantly enough along the full trajectory, that could have an impact on the monetary policy. But there are several if there. So we have to, assess all those if in between before having a feedback into policy decisions.
I have a question about the box that you have in the bottom of the labor market. So with higher wages and slower job creation, what impact do you expect on the wage bill looking ahead? Maybe you can tell us your opinion and how will this affect consumption, savings, and inflation?
Well, I show you the wage bill going up. There was some slowdown at the beginning of the year, but now it just picked up. We have not a official, forecast for the wage bill. We have a view, more speaking, broadly speaking, regarding the unemployment. Employment should be going up as long as the economy keep on growing. We see more investment coming down the road. Therefore, employment should keep on growing. And also, part of the push on wages has been related to regulatory issues that have been already went through. So those effects should be fading away over time. So probably we will have a combination of more dynamic employment, less dynamic wages, and therefore, all in all, the wage bill itself should continue growing at the trend that we have seen in recent months. Part of that is why we have revised upward consumption, because we see that there are some fundamentals, including the wage bill, that sustain consumption and will sustain consumption during the next quarters.
If I may ask a follow-up on activity, on investment, Claudio. You touched briefly on the spillovers for the rest of the economy. But if you could elaborate on how much you see this surge in investment in mining and energy, which are not, it's different from construction, etc. But how do you see those spillovers for the rest of the economy, particularly perhaps also on the labor market, right? As if that could be a source of recovery for job creation.
Well, mining activity in general, copper production, let's say, has not too many spillover to the rest of the economy. It has an impact on public revenues, on activity itself, but there are not too many spillover. But mining investment has a lot of spillover to the rest of the economy. Okay, there are some services. There are several services associated with the investment. You have the whole impact on the construction. Many construction companies either are linked to building construction, so housing construction, or they move around depending on the cycle to housing construction or supplying services for mining activities. And what we have seen in this time, since a year or more, is that those companies have moved towards mining activities to support all the investment process, and that also creates jobs. Therefore, part of the demand for jobs that we have seen up to now is linked to the dynamism that mining investment create. Probably this is a long cycle. This is a not short-lived cycle. It's a more longer cycle. When you look at the cadastre of the Good Capital Corporation, it shows that in the pipeline there are several projects coming in, and therefore this could be a long cycle. And then there are some other projects linked to energy that will be coming into the pipeline. Project linked to green energy, green hydrogen, and stuff like that. So probably we will have this longer cycle in terms of investment. But up to now, the main driver is mining. And why is that? Well, because the copper price has remained high, and the view in terms of the long-term price, I think, have been moving up. We haven't changed our view, but it seems that the market at least has been changing views regarding the long-term price of copper, and with this price probably is profitable to invest, and that's why we've seen more activity there.
Clear. Seba?
I have a last question on my side. It's about the difference between GDP forecast between the central bank and the market, but for 2025. So for the third quarter, the forecast is very similar. Like the central bank expects 2.5%, the market 2.3%. But for the last quarter of the year, you have a 2.4% for the fourth quarter, and the market 1.8%. So why do you think there is a 60 bips gap for the end of the year? And if you think the market maybe is too pessimistic or underestimating some factors like maybe private consumption?
Well, I don't know exactly what has the market behind the forecast. We do a forecast based on several approaches, and one of them is linked to demand. And as I show you, at least the data we have already for the third quarter, we have data on COMEX for the third quarter, show that there is still very high dynamism for investment. That's why we think investment will continue to push up activity. And also we have this view in terms of consumption being a persistent component of demand that we have revised upward. And then there are some specific effect that we saw in the third quarter, like this accident that we saw in El Teniente. Is a very important mine by Codelco that was shut down. They stopped producing for a couple of weeks. as long as they keep on production. Back again, they will have a rebound effect that will have an impact on the third and the fourth quarter. And that also can explain part of the rebound we have. And I don't know exactly what the market has for the fourth quarter, but that is what is behind our forecast.
Claudio, there's a question here in the Q&A that we haven't addressed. With inflation evolving in line with IPoM, what would be the costs of an October rate cut?
The cost of a cut. Well, I cannot speak about the cost of policy decision that has not been taken. What I can tell you is that basically we have a corridor. It's true that you can, download the Excel and to have, the middle point of the corridor, but we have a corridor. That is what is published there. So the decision for policy rate are being taken on each monetary policy meeting. And then we have to evaluate whether the conditions for cuts on each meeting are met. And that implies having a view on the convergence of inflation within the horizon and the risk that we see for that convergence. And that is what we are going to evaluate in our next policy meeting. The decision is not decided. I mean, we don't have a decision for October. That's why we have a meeting in October. But what we can see with the data that we have now is that probably cuts will be smoother than what we had previously, coherent to the view for inflation convergence. Now, if we are convinced that those conditions have changed from now until October, then we can reassess, or each one of us, when taking their decision or they vote, might reassess. Okay?
Clear. Claudio, if I may ask one last question. This one is more technical, but since you had your long experience at the central bank, you might be able to address it. When we run the central bank models here and see the output gap that they produce output gaps that are much more on the positive range and significantly above the one that well, in the previous, at least in the last three IPoMs. Can you help us understand? I mean, of course, it depends on a bunch of things, but from the point of view of the central bank, why are you getting such output gaps around zero over and over?
Well, there is a visual effect here. We discuss about that internally. The gap moved so much during the pandemic that when you look historically, gap seems to be very, very muted right now. But part of that is this visual effect because we in the sample we're still showing what happened during the pandemic, where we had very significant deviation of activity from the normal trend. The trade-off here is to show a shorter history of the gap and lose what can tell you the history about what are normal movement, vis-a-vis showing that part of our history where we had such a large volatility that mutes the readings at the margin. Probably for the next IPoM, we're going to shorten the period that we are showing to be more precise, probably, or more clear in our communication regarding the readings. Having said that, the economy probably is not too far away from trend. If you look at our past reports, we haven't changed to a large extent our forecast for growth for next year, for previous year, for this year, for next year. We haven't changed much our view in terms of the trend GDP, and that's why overall the output gap doesn't move much. Okay, so we haven't had that many news that could explain or could justify changing the view in terms of the outlook gap.
Perfect. Claudio, we are already 2 minutes past 4. Want to be respectful of your time. Thank you so much for your time and this very timely call. Hope we can see you again in the future. Thanks for everyone who joined.
Yeah, thank you for the invitation, and I hope it was helpful for you.
Sure. Thank you. Bye.
Bye.